Hey, how's it going, guys? Man, what a crazy start of 2021. If you haven't heard about GameStop, you're probably living under a rock. I won't repeat the entire story again, you can pretty much read them everywhere on the mainstream media nowadays. In this video, what I do want to focus on are some of the extremely important points that the mainstream media have missed or purposely not to tell the public over the couple of weeks. This GameStop mania has created both short-term and long-term impact on the US equity market that you cannot afford to ignore. This is why I dropped this video to deep dive into this impact and help you guys navigate the whole market after this fascinating historical drama. Alright, let's get started. To understand the whole story and the market impact, first of all, we need to fully understand what is a gamma squeeze. A squeeze means those times when there is a rapid price movement in the underlying stock, and such movement forces investors to unwittingly make substantial changes in their position size. In other words, when investors are on the wrong side of the squeeze, they have to make the trades that they don't want to take in order to either cut loss or meet the margin requirements. Then what is gamma? Gamma is one of the most important option Greeks that the market makers use to price an option contract. To understand gamma, we need to understand two things. First, we need to know how the entire options market works. Options are traded a little bit differently than the stocks. When you buy an option contract, chances are you are not trading with another individual investor, but rather with a market maker. In our case, it's the brokers like a Robinhood. This is how it works. Market makers like Robinhood will create a long list of different option contracts with different strike prices and different expiration dates. We call this the option chain. They will use extremely sophisticated pricing models like the Black-Scholes options pricing model to determine how much each of these option contracts premium should cost. When you buy or sell an option contract from your broker, you are basically betting with your broker, not with the underlying company directly. Which means for every single dollar profit you earn, your broker will lose the same amount of dollars as a loss because they are obligated to deliver the underlying shares once the option is expired. Then you probably wonder, why the heck does the market makers want to do such a risky business? The answer is pretty straightforward: the fees. Brokers can purposely manipulate the option pricing model, adjust the spreads between the bid and ask prices to make sure they can always make money whenever people make a trade. This is why you should never buy the ideas of free commissions from some certain brokers like Robinhood. Nothing is free. Your commission is actually charged potentially much higher with Robinhood, and those fees are hidden in those spreads each time you put on a trade. But in order to make this business happen, brokers need to make sure their options contracts are delta neutral. Meaning, no matter the underlying stock price goes up or down, it won't affect their total profit and loss. Then the only way to achieve this is to use the delta hedge. Delta is another option Greek that measures how the price changes in the underlying stock that affects the value of a stock's options. For example, if a July 2021 GameStop call option on Robinhood has a delta of 0.25, then if GME stock goes up $10, this call option value will increase $2.5. The main goal of delta hedge is to make sure that the value of delta for each option contract is zero. In order to achieve this, Robinhood has to make another trade and purchase a certain amount of underlying stocks every single time they sell a call option to their customers. The amount of underlying stocks Robinhood need to buy is based on the value of delta. Because one option contract represents 100 shares of underlying stock, if the value of delta is 0.25, then that means for every GameStop call option that the Robinhood sells to their customers, they will have to buy and hold 25 shares of GME stocks in their book to hedge that trade until this contract is exercised. The higher the delta, the more underlying stocks Robinhood has to purchase in order to have an effective hedge against the call options they sell to the investors. So we can imagine how important it is to calculate the correct value of delta for those brokers like Robinhood to stay in the business. This chart shows exactly how the value of a call option delta changes along with the changes in the underlying stock price. As we can see, the value of delta doesn't change linearly, meaning the rate of change of delta constantly changes. And this is exactly where gamma comes into play. Option traders use gamma to represent how fast the delta changes with the underlying stock price changes. Or simply put, the rate of change of delta. Gamma has the smallest value when an option contract is far in the money or far out of the money, and it has the highest value when the option is right at the money. Once we understand all this, now we can come back to our GameStop case and you will understand how exactly this epic gamma squeeze happened, and it's not what the mainstream media has been telling you. First, we have hedge funds like Melvin Capital were betting against GameStop with massive short positions. In fact, the short positions were so large that it's even bigger than the total amount of GME shares combined together available in the market to trade. The float was 140% at its highest point. Because the position was so huge, as a part of the risk management, hedge funds will be required to purchase a certain amount of the long-dated out-of-the-money call options as an insurance to hedge the potential short squeeze. The market makers had to purchase a certain amount of the underlying GME stock to hedge those out-of-the-money call options that they sold to those hedge funds. But because the delta value was extremely low when the stock price was way below the strike price, market makers didn't have to purchase much of the GME shares for the sake of hedging. However, this all changed when the retail traders on the Reddit group called Wall Street Bets decided to get together, YOLO their life savings and load up call options on GME stocks. Because of this sudden buying, the brokers like Robinhood and all the other market makers are forced to buy the underlying shares, which create a sudden short squeeze on the stock price. When the stock price goes up, it gets closer to the strike price. The closer it gets to the strike price, the higher the value of delta a call option will have. Then it means the market makers like Robinhood are forced to buy more shares to delta hedge for every single call options they have sold. But this is not the killer. The real killer is the gamma. When the stock price increased from way below the strike price to hitting the strike price, the value of gamma was squeezed from nearly zero to the maximum value in a very short period of time. That means the market makers like Robinhood had to dramatically increase their purchase on GME stocks. And they suddenly realized that they sold way too many out-of-the-money call options, and now they have no choice but to keep buying more and more underlying shares to neutralize the delta to protect themselves. And such forced buying due to the sudden gamma increase will keep driving the share price up. The higher the price, the higher the delta. The higher the delta, the more shares Robinhood and all the other market makers are forced to buy. This gamma squeeze forced the GME stock into this vicious cycle and it went up 1800% in a week. First, this gamma squeeze hurts those hedge funds big time. Melvin Capital lost 57% of their entire fund and almost forced to liquidate their entire hedge fund in a week. Second, it actually hurts Robinhood as well. Because of the sudden gamma squeeze, Robinhood was running out of cash to buy those underlying GME shares. And that's why we're seeing they urgently raise $4 billion in total over the weekend to save themselves. Those retail Wall Street Bets traders didn't realize that while they were trying to destroy those hedge funds, they also almost put Robinhood out of business too. Although what we have witnessed over the last couple of weeks could be one of the most epic gamma squeeze in our history, one extremely important thing we have to know about gamma squeeze is that they are always the sharpest double-edged sword in the market. Which means, for the same reason the share price goes up like crazy due to the market makers force buying, it also goes down from the top just as crazy as it goes up. Because when those options expired or exercised, those market makers will no longer need to hold those underlying stocks. They will definitely liquidate them as soon as they can. Eventually, this will hurt those retail traders who are still holding GME stocks. And that is exactly what we're seeing in the rise and the fall of GameStop drama. Love it or hate it, one thing for sure is that the impact of the retail crowds is here to stay, and it can create both short-term and long-term impact to our financial market, especially the US equity market. Over the short term, GameStop gamma squeeze dramatically changed the US equity index allocation. Although GameStop is not a part of the S&P 500, it is, however, a part of the Russell 2000, the US small cap index. Before January this year, GME was only 0.02% of the entire Russell 2000. But now, after this epic gamma squeeze, GME is around 0.3% of the entire index, and that is a huge change. Why this matters? Two reasons. First, because of this sudden increase in the GameStop percentage, all those small cap index funds and ETFs are forced to buy more GME shares to rebalance their overall allocation, and that dramatically increased the price of the small cap ETFs. Second, on the other hand, the fundamentals of GameStop and as well as most of other small cap companies haven't improved at all. In fact, their earnings are still in the free fall crashing phase due to the COVID lockdown. And that is exactly what we're seeing in these crazy charts. There is a huge divergence between US small cap ETF's price and the underlying company performance. In the short term, we can definitely expect there will be more hedge fund money to jump in and take advantage of this no-brainer arbitrage trade opportunity that is accidentally created by the retail crowds. The long-term impact of this whole GameStop drama definitely deserves an entire video to dive into, and it could be extremely technical. But in this video, I will do my best to summarize it in the simplest language to make sure all of you guys can understand. First of all, as I mentioned earlier, the retail crowds are here to stay, and the movement just gets started. Although the smart money still remains in power, the dumb money is no longer dumb anymore. What all this means is that the volatility of US equity market will still remain high over the next couple of years. And this creates a couple of extremely important issues that deserve our attention. And the most important one is the VAR, or the value at risk. You see, the retail investors can completely ignore the volatility of the market and YOLO everything on some call options. But on the other hand, the institutional investors cannot run their money this way. Their buy and sell decisions, along with their position sizing, are highly inverse correlated to the market volatility because of the thing called value at risk. Simply put, value at risk means the lower the volatility of the market, the higher leverage they're allowed to take in this market. But the higher the volatility, the less leverage they can take. As the retail YOLO investing is here to stay, the VIX will stay high for much longer time. And what this will do is that it will force those institutional investors to start entering a quiet but a massive deleveraging phase. It may not directly cause a rapid sell-off or crash in the market because those fund managers will do whatever they can to avoid it. And also remember, the Federal Reserve just printed more than $4 trillion over the last 12 months, and they are not going to stop anytime soon under Biden administration. There's plenty of liquidity in the market right now. But inevitably, we will see a gradual capital outflow out of the US equities to other asset classes, like for example, emerging market, precious metals, and even Bitcoin. What this means is that if you care about your overall asset allocation and the entire portfolio performance over the next couple of years, your US equity component will dramatically underperform compared with the rest of the asset classes. So over the next couple of years, we will see a trend of a massive capital rotation from the US equities to other asset classes, especially the emerging market, precious metals, and the cryptocurrencies. And this GameStop drama just accelerated this capital rotation process. One of my favorite fund managers, Chris Cole, has nailed the situation perfectly with his recent tweet. The US stock market is now the derivative of the US options market, a Frankenstein monster patched together with the liquidity injections and a short gamma. So I'm already reducing my US equity exposure and loading up on Bitcoin, precious metals, and slowly adding up on emerging market equities. Where the second long-term impact is that this GameStop drama perfectly exposed the true color of those retail brokers like Robinhood, and this is huge. I understand the current narrative on Robinhood is that they're in bed with those hedge funds, stealing money from the retails, and doing whatever they can to manipulate the market and to protect those hedge funds. Yes, I agree with this narrative, and yes, I'm a total supporter of a real free market. But this narrative only covers a tiny part of what is truly going behind the curtain. This GameStop drama and the sudden gamma squeeze led by the retails accidentally expose how fragile our current financial system is, how undercapitalized these market makers are, and how greedy these market makers trying to squeeze every single dollar they can and completely ignore the risk. Basically, the entire Wall Street is massively on the short gamma side, which it never happened in history before. Luckily, because of the COVID pandemic, that forced the Fed to inject plenty of liquidity into the market, which is a luxury thing that a 2008 GFC didn't have. But if all these financial institutions like Robinhood continue being greedy and keep doing what they do, this GameStop mania is just a sneak peek of what can truly happen to our entire financial system. And when the liquidity eventually dries out, it could potentially bring the most epic crash we'll ever witness in our lifetime. Although I don't think this will happen in the short term, but over the long term, the combination of the retail YOLO investing crowds like the Wall Street Bets and financial institutions like Robinhood and the Melvin Capital could create a perfect storm that collapses our entire financial system. Alright, that will be the end of this video. If you are new to this channel, my name is Vic. I make videos every week to share some of my thoughts on what is going on in the financial market. And I also share some educational contents to help your investing journey just like this one. If you are interested in the world of finance, the business, and find my videos being valuable to you, please consider subscribing. Again, thanks so much for watching guys, and I will see you guys soon.